Okay, welcome everybody. It's 9 o'clock my time here in Queensland from our home office here, and 10 o'clock in Sydney time equivalent. So thank you for coming along. And this webcast is all about getting you in the mindset for becoming a successful SMSF wealth creator. My name's Russell Markham. I'm the Director of Education here for Asia Pacific, and it's just great to see you here on the dashboard. Yeah, plenty of people in attendance today, so thank you for coming along. I'll turn off the camera shortly, but I wanted to just do another quick sound check again. Hopefully I'm coming through okay. I can see on the second computer here to my left, I can see that the audio is coming through as well as the video. So it looks like we've done all the checks and balances and we're ready to go. And just before I get going today, I want to tell you something that's quite interesting. Some of the portfolios that I've put in for this course, I'm going to talk about this course. And if you're interested at the end today, I'll give you some links and you can consider if you'd like to come along. But the portfolios that I've put together, I was just looking at the latest updates because I'm invested across all of them as well. And I'm smiling ear to ear because the last couple of days have been very, very good. I've done the homework. I've stress tested a lot of these portfolios over 10 to 20 odd years for the ones in the United States. Wait till you see some of the sneak peek in terms of what I'm going to show you today. I wish I could give you all this information for free, but being it as it is, a lot of work and time went in there. And we are looking to recover some of those costs for putting it all together, but you won't be disappointed. Okay, so what I'm going to do here is I'm going to move this across. I'll minimize myself for now, and let's get into the sneak peek today. All right, so becoming a successful SMSF wealth creator sneak peek. Okay, so let's jump in here to the next slide. So just a disclaimer. Please, I cannot take into account your personal financial circumstances. I put a disclaimer notice down here for those of you tuning in from Europe. We have to now put that in as well. Okay, so I can't take into account your personal circumstances. Please do speak to your financial professional for your circumstances. All right, it's a picture of me. So you've just seen me on camera. That picture's probably a bit more flattering. It's about 3 or 4 years of old now, so I was a little bit younger back then. I started trading shares at around about the age of 22. That's when I got the bug. And I made all the mistakes you could ever possibly make. All right, I learned my lessons the hard way and I nearly gave up. However, I stuck it out and decided to admit that I didn't know what I was doing and I wanted to improve things. 23 years later, here I am, and thank goodness I never gave up. I'm living proof that you can be very successful, and with a bit of work and effort, you too can become a stock market wizard. And as you all know, VectorVest has given me the competitive edge. For those of you that are new and you've never seen or heard about VectorVest, I've been using VectorVest now for just on 10 years. So VectorVest has been my competitive advantage, and anyone, as I know, who's known me knows that I use it. All right, so there is a total in terms of the course outlay, right? So just to set expectation here, I'm going to give you a little bit of a sneak peek to the successful SMSF wealth creator course. And, you know, I'll just put it out up front there. My objective by the end of this webcast is to get you interested in possibly looking to attend the course. I'd love for as many of you as possible to join the course, because at the course there I can go into a lot of depth and a lot of information in terms of what we've put together. It's very difficult on a 1 hour type webcast to give you, you know, all the nuts and bolts. Of course, I couldn't do it. And that's why we effectively run it across several modules. All right. So there are 5 recorded modules, which I've just completed the 5th and final one. They're about an hour each. Some of them go a little bit over an hour. You can watch these as many times as you want for the next 12 months. And then what we do at the end of each module, so we'll release a module and we'll give you a few days to watch it. And then at the end of each module, we'll then hold a mastery session, right, whereby we'll go through all the information taught at each module in more detail, and we'll answer all the questions that you may have in regards to that module. Right, the modules are released, you know, in a timely manner. We don't want to just put it all out up front in one hit, because we don't want you racing ahead. We want you to spend your time mastering each module. So we release it, then we have the mastery session, and we release the next module, etc., etc. All right, so module 1's all about developing the mindset to becoming a better investor, right? Because a lot of the mistakes that investors make, it's us. We're actually the ones at fault. All right, you know, and you know, if I ask this question here, don't worry, don't need to answer it in the Q&A box. But if I said to you, did you feel despair, and did you feel like giving up around about September, October last year? Did you sort of look at your portfolios and go, oh, this is all too difficult? all right? And if you were feeling that way, I appreciate, I understand the market was difficult, but you think about it, who were the people that were in the market trying to battle away against the tide? These were often people that didn't have any appreciation for market timing. All right, so hopefully you weren't one of those, but there were many out there. All right, in Australia, and investors and around the world, they were battling away, looking at their portfolios, whittling away over September to December, feeling very, very frustrated. Our VectorVest subscribers, we told you to stay out of the market. We told you to stay out of the market around about, when it was the 30th of September, we gave our confirmed down signal, and we told you to only consider buying shares again on the 9th of January. All right, so we give you the tools whereby you can then control your emotions rather than sort of trying to second guess yourself. Right, in module 2, so that's what module 1's all about. It's giving you those tools and the mindset, and then as discussed, market timing. So module 2 is heavily into the screening techniques, and also we talk a little bit about market timing, going into quite a bit of depth actually on market timing. It's very important to get our market timing right. And then module 3, it's all about starting to develop our mechanical trading plans. And this is where a lot of work went in, not only for Australia, but also for the United States, because I know a lot of investors here in Australia look not only at Australia, but also at the US. And if you're not looking at the US, why not consider the US market as well? Okay, so there's over 8,000 shares that you can consider. And yes, you can hold US shares in a self-managed super fund. Right, so module 4, we then get on to module 4, and it's all about putting some techniques together for short-term investing. Now, I'm not saying that this is going to be all about short-term trading and you need to do short-term trading in your self-managed super fund. No, I certainly would not advocate that. This might only equate to maybe 5 or 10 at the very most % of any of your capital at any point in time. So the bulk of your investing strategy is going to be covered in module 3. So we talk about our worry-free investing systems. You might dedicate a few % to the shorter term techniques that effectively help you bring in some money. And then by module number 5, all right, it's all very well covering all this great theory and showing you exactly how to do everything, but we need to put it into a plan. And that's where module 5 becomes really important to show you exactly how to do it. Okay, so in week 1, we're going to look at what we need to focus on to become a successful investor. All right, so we'll spend a fair bit of time on the ingredients entailing fundamental and technical analysis on stocks. We'll teach you some easy to apply techniques such that you have the tools to find top quality stocks. All right, so what is required? So we are going to show you a proven system. Right, VectorVest has been in the market now for just on 30 years. Right, so a proven system. We're going to apply disciplined money management rules. We're not just going to simply buy, hold, and hope. We're going to learn how to play the game of investing. You know, when I think about that term, it's so true. I was explaining this to a gentleman the other day that was new to investing, and I said to him, you just got to remember at the end of the day, it's just like he's a rugby union fan like myself. And I said, it's like a game of rugby union. You know, you've got to understand what you can and can't do, and you've got to play within the rules. And once you understand the rules, then, you know, the game becomes enjoyable. You go against the rules, you get a red card, you get sent off. It's the same with the market. Understand how the market works and play the game as the market works. The game does not involve buying and holding and hoping. All right, that game doesn't work. All right, it may have worked in property over the last 20 odd years. That strategy certainly doesn't look like it's working anymore, right? But in the game of shares, we're going to lock in our profits. We're not going to get too greedy. If we're up 10, 15, 20%, we take our money off the table and then we look for the next opportunity. Just for a peace of mind in terms of the portfolios that we put together for this course, we are not going to be going in and out like a yo-yo into the market. All right, so we're not going to go up and down, in, out, into the market. A lot of these portfolios here, you'll be doing less than 10 trades a year on average. Right, less than 10 trades a year on average, because it's got to be realistic and it's got to be something that you would seriously consider looking to do. All right, to set the scene here. So this is how the mathematics comes behind the game, so to speak, of investing. It comes down to probabilities of success. Now, if you think about it, there's a lot of businesses that use probabilities of success to get good returns. All right. probabilities of success. So if I was to buy a supermarket, for example, I know that there's a good probability that people need to come to the supermarket on average once a week, right? So you're putting the odds in your favor. You know, buying into something where there might be low demand. If you think about it, insurance companies, right? Why do insurance companies, how come they've got such fancy buildings and some of their executives get paid so well? They're in the business of making money, believe it or not. Sure, they protect you through premiums and whatever have you and payouts, but at the end of the day, they are a business. They're putting the odds in their favor. And the odds are, chances are that they're going to receive a lot more premium than they pay out. So with the game of investing, what we're going to do here is we're going to look for the types of returns that we're more likely to get, and we're going to minimize out of situations where we're more likely to lose. Okay, so let me show you here. Here's an example. So let's bring this one up here. What if I were to say to you as follows? Which one would you prefer? You can risk, all right, so you can risk 90% for a 10% return, and you're correct 90% of the time. Just a little bit of a mind teaser, this one here. For you statisticians, you probably already worked it out. The second one here, risk 10%. You're risking 10% of your capital for 20% returns, but you're only correct half of the time, 50% of the time. So let's break it down a bit. Let's assume you've got $100 to invest, and let's just pretend there's no transaction fees. Okay, so we'll make it nice and easy. So for option one, you risk 90% for 10% returns, and you're correct 90% of the time. So out of the 10 purchases, so let's say you now make 10 purchases, so you risk 90% and you're successful 90% of the time. You have 9 successful trades, and you return $10 a pop. Okay, so you're returning $10 a pop, so you got $90 in total for your 9 trades, right? So you're feeling good, you've made a 90% return, but then your 10th trade comes in by the law of odds and statistics, and that one there you lose 90% of your money invested. I'm just going to assume we're investing 100 each time, right? So you therefore now made 90 and you lost 90. So your total returns there are 0. So if you were an investor looking at that type of trading type system, chances are your odds are that you're not going to make much money at all. All right. For option number 2, you risk 10% for 20% returns, and you're correct half of the time. Right. So out of the 10 trades, again, let's assume we're investing $100 a pop, no transaction fees. So out of the 10 trades, 5 trades are returning $20 each. All right, so $20 each for those trades you place. So you make 5 times 20, which is 100. And then the other 5 you lose, but you're losing $10 a trade for a total loss of 50. So you've made 100, and then on the other side, you've lost 50. So you've made a total returns there of 50 out of 100, or 50%. Your odds there on average are 50%. So you're likely to make $50 for every $100 you invest across 10 trades. All right, and that's how we start to formulate how you're going to build a trading plan. We are going to minimize our losses and maximize our returning capabilities. We're going to put the odds in our favor. So your expectancy is making more when you are right than when you get things wrong. An optimal balance is struck, which entails risk to reward, success rate, and commissions paid. Now, I've seen plenty of trading plans that have a 50% or lower success rate, but the returns are good. Why? Because when those portfolios make a return, the returns are good and steady, and when the portfolio makes a loss, the losses are small. All right. I've seen portfolios where it only wins on average 20 to 30% of the time, but it's still having a very good return, annualizing 10 to 15% a year or higher. At the end of the day, what really pays the bills for us? It's the actual returns that we get in the hand. Now, as a rule of thumb, you want to keep your losses to no more than 1% of your investable capital. So take, for example, a self-managed super fund or investment with $50,000 balance to invest. Limiting your loss to no more than 1% of your investable capital would entail a maximum loss allowed per trade of 100. Okay, so maximum there of, maximum loss there of 500. Okay, so we should never lose more than 500 in any single investment. And when you're experienced and profitable, then maybe 2% but not more ever. Okay, so no more there than 2%. So a quick overview of setting lot sizes can help us, right? So here in slide number 11, I've got an example here on lot sizes. So in other words, how much are we going to look to invest into a given stock, right? So, you know, if we're going to look at this in terms of setting our lot sizes here, we're going to set it such that we're not going to risk more than 1% of your total account size in that given share. That's going to be our buying power, no more than 1%. So if you were to buy, say, Goodman Group for $11.69, and you set your loss at $10.68, your loss therefore would be 101 a share, right? And to calculate the holding size, you then apply the formula, and I've put the formula down there over here. So effectively, N being the number of shares is the risk allowed divided by the risk taken on. So the risk, no more than 1% of our investable capital on 50,000 is 500, and the maximum loss, so the stop loss, the most we could lose on the share based on stop loss is $1.01, which would therefore equate to 495 shares. If you think about it, 495 shares multiplied by 101 loss would therefore take you no more than $500 in total losses. $500 in total losses is no more than 1% of your total investable capital. Okay, so let's jump to the next slide here. So hopefully that's useful in terms of setting your loss sizes. So here's the graph there of Goodman Group. So we will buy in at, say, $11.69. So this was just the other day, for example, $11.69, and we could then put a stop loss, for example, at $10.68. All right, so you see over here, $10.68. This is the VectorVest stop. This is just one such example that we could apply as a stop loss. So one of the key aspects of this course is to take away human emotion. Now, it sounds cold, but that is how you must operate as a successful investor, right? So if you have difficulty in keeping your emotions under control, then VectorVest has the tools to assist you. Your emotions can be your biggest enemy. If you're looking over your shoulder all the time and reflecting back on given investments and clouding your judgment with thoughts such as, if I sell now, I'll have to lock in a loss, so I'll not sell. Right? That's not a good way to think. Or what about this one? If I sell now, it'll probably go up another 20%, so I won't sell now. All right, so that's not a good one, right? What about this one here? So that was the greed one. I want to buy many more of these shares as I believe they'll go up more, and I'm just going to keep loading up. So it's a greed factor kicking in yet again, right? What about this one here? I should have sold last week, but it's too late now. I guess I'll just have to wait this week out to see how it turns out. So it's a bit of a despair, lost hope type emotion, right? So if you're thinking along these lines of what I've just noted, you're most likely going to experience a loss, right? So you want a system that removes the emotion to your investing, a system that you have stress tested, you're happy with, that makes much more than it loses on average, not just currently, but consistently year in and year out. So you want to go and test it over a couple of years. So we want to take away that emotion, that gut feel, all right? We want to base this on scientific, factual results and outcomes. So if you ever get somebody that's an investor says, well, you know, I've gone out of the market currently because I just have this gut feel that, you know, I need to get out. That's a dangerous approach, all right? Do not base it on gut feel, base it on scientific mathematics, right? To do this at VectorVest, we consider some very important aspects to our trading plan, and that being fundamental data on stocks, technical analysis, and we also look at market timing. So fundamental analysis is a search for true value of a share. So in the long run, a share is said to be priced up in terms of what it's worth, but it does not always work out like that, and you need to consider the technical side of things. So technical analysis is a study of price trends and turning points, and at VectorVest we combine the two. Why not find top fundamental stocks that have strong technical analysis behind them? By combining both the fundamental and the technical analysis, you're in a much better position. So over the next few weeks, so 5 odd weeks here for this course, we're going to show you how to become systematic, prepared, and disciplined. And we're going to show you how you can improve your success rate based on tested trading plans. So we will apply the power of VectorVest to analyze our stocks, and we will look at some fundamental and technical analysis. Right, so the best defense is offense, right, or attack, rather than being attacked. So we want to attack the market with knowledge, fundamental and technical analysis, with market timing knowledge, with back testing knowledge, so we know what we're getting into. So we want to trade in the very best shares, those shares with the best combinations of value, earnings growth, earnings safety, and earnings that are rising, as well as a rising share price. Now, if you put the best stocks into your portfolio, then just by default, those top stocks will help drive the portfolio, right? Just like with a sports team, fill your team with the best players so you can get your hands on, and by default, those sports teams with excellent players will do very well on average, right? It also comes down, of course, to good management. So we're going to fill our portfolios with some of the best shares money can buy, and then we're going to be some of the best managers around. So when investing, some of the key things that we'll show you is value goes up when earnings go up, when inflation goes down, when interest rates go down. And we'll cover this in the course to assist you further. And if you think about it, currently in the Australian market, earnings season is just about to kick off. So in the States, they've just had a lot of their earnings seasons, and a lot more came in above earning expectations than went below. So hence we're seeing that market continuing to power on again. What's going on in terms of inflation in Australia? We're seeing fairly low inflation by historical standards, and interest rates. Well, we had the RBA come out the other day saying that they're likely to cut interest rates in the near future, which sent the Australian dollar sliding a bit. So VectorVest believes every investor should know what a stock is really worth, how safe it is, and when to buy, sell, or hold. And we'll show exactly how to do that in the course. So we're going to show you several key indicators to ensure that you can find top fundamental and technical stocks. Now, for existing subscribers, you'll know this one here, relative safety, and CI being the comfort index. But here's one such graph where the power of both fundamental and technical analysis is in play. Right, and if I ask the question here, do you like the look of this graph? A rhetorical question, right? Unless you're shorting it, of course, it looks great, right? Over a 5-year period. This is not just a, fly-by-nighter. It's done well. This is consistently done fairly well over the years. So, would you like a stock like this in your portfolio? And would a stock like this over the last 5 years have helped you? Of course, right? So, how exactly did VectorVest establish such a graph? And of course, we'll cover this. So, here's just a bit of a snapshot. So, for example, here, our relative safety indicator on a scale of 0 to 2, it's been holding consistently at 1 or higher, a little bit below there, but on average, it's been well above 1. Tells us that this company's got good, consistent financials. And this indicator here, CI, being our comfort index indicator, when it's above 1, that's often a good sign, right? It's telling us that there's good momentum, sustainable momentum. You can see over here in recent times there, it was above 1 with the RS above 1. You would have made a small fortune there. Here, the RS is holding above 1 with the CI holding well above 1 again. Another small fortune made over there. All right, so this then gets us to week 2. So in week 1, we looked at all the fundamentals and technicals. We then get to week 2. All right, so here's that roadmap again. So in module number 2, we're going to show you some very powerful techniques to find some of the best stocks around using VectorVest. We're going to make a use of our tool there called UniSearch. So it's a tool that shows exactly how this is done. There is a new search that I'll introduce you to for those attending the course, which is not available other than to the attendees of the course. So the sheer power of this tool is mind-boggling. You can rank, sort, and scan for just about anything, and we'll give you those tools at VectorVest when you're in the course. Okay, so you're going to have access to all that. For those of you that are new to VectorVest, we're going to give you all these tools as part of the course. All right, so you can analyze over 10,000 shares. So we're going to give you access to both Australia and to the United States. So you'll have access to look at over 10,000 shares every day, where you can go and screen stocks for certain criteria. So you can go and look, for example, in Australia, find me stocks where the dividend yield is 2% or better. Find me stocks where earnings have been rising. You go and do the same in the United States. In the US, you've got a whole lot of extra things you can do because you've got such huge market liquidity. You can go and start putting in ridiculous parameters, and chances are you're going to probably find those stocks. Find me stocks that have a market turnover of more than 700 million US dollars a day. All right, you'll find those in the United States. You won't quite find as many in Australia. All right, so we then get on to market direction or market timing. So in module 2, we're going to cover the important aspect there being market timing. So you get your market timing wrong and your returns suffer as a result. As studies have shown, as to have our countless back tests, even bad stocks can really rally in a bull market. So why not have some of the best stocks working in your favor when the market is powering up? So we want to bind the stocks with the combinations of fundamentals and technicals in a rising market. So your returns can be significantly higher. So let's assume you're now in top fundamental and technical stocks in a rising market. Then what? How do you protect your downside, right, when it takes place? Because it will at some point. The market does have cycles. So how do you know when the market is about to turn? So that's what we're going to cover in this course. We're going to show you exactly how to identify those turning points and protect yourself. So VectorVest believes in buying rising stocks in rising markets and selling falling stocks in falling markets. We do not advocate time in the market. We advocate timing the market, right? So we do not advocate, as I noted before, a buy, hold, and hope type strategy. We are proactive and we manage our risks accordingly, right? With a few trades a year to lock in profits and protect the downside. Our portfolios in this course are very reasonable, as I noted before. So you're not going to do many trades a week. So less than 10 trades on average a year for these portfolios. So some of our portfolios do no more than 1 trade a month on average. In fact, I was looking at one just the other night there as we continue to stress test it leading up to the course. Some months it does no trades. So as I found in notes, right, direction is key to making money in any market. So being on the wrong side of the market is the worst thing that can happen to an investor. And it doesn't have to happen to you. So if you were in the market from September to early January, September last year to early January, you didn't have to suffer as the market was having quite a steep correction. If you had VectorVest, we would have told you to not buy any more stocks during that time period. Sadly, too many investors ignore market direction, and as a result, they suffer unnecessarily. The experts out there will tell you to buy, hold, and hope, right? Because it's good for them. If you're a fund manager, how do you make your living? It's funds under management, right? You earn a trailing commission for the funds under management. Is it not your best interests to keep your clients invested into the market? We do not hold money on behalf of clients, okay? So if we tell you to get out, it makes no difference to us whether you're in or out from a financial perspective, but it does make a difference to us in terms of our subscriptions. Because if you think about it, if we're advocating to be in the market and you're losing money, guess what? You're likely not to continue your subscription with VectorVest to say, well, you know what, this doesn't work, right? So it's in our best interests to look after your best interests. So here in Australia, let's have a look. Here's market since 2007. Now, the market during the global financial crisis, it fell roughly 50%. As a result, you need to make a staggering 100% returns just to break even. Sadly, this may prove too long for many investors to recoup their losses. If we look at the US here, much like our market, right? So a similar thing took place there, right? So in the US, for example, the volatility started to dry up after 2009, early 2009, and the US market, as we know, has had the longest rally in the US history since. It's powered on. And this is why in this course we're also going to look at the US in addition to Australia to give you all the tools so you can make the right calls to enhance your wealth. So once you learn how to analyze Australia, the exact same tools and techniques can be used in the US market. Right, so you see over there just how well the US market's powered up. There was the big correction, right? So it was quite a steep one, but look at that, it's rocket right back up. And if I was to update the slide until the current date, it'd probably be just up to that point there. Okay, so a good recovery going on at the moment. It's an exciting time to be part of this course, because if you think about it in terms of your timing, you're coming in as there's been that correction and the rebound has started. A very exciting time to be learning a lot of the techniques that we're going to teach you. All right, so VectorVest has been timing the market for over 25 years, just on 30 now, and has perfected several systems that identify market trends with accuracy and precision. We have long-term systems for investors and shorter type term systems for traders. In this course, we're going to specialize quite a bit on the longer term type systems, but in module 4, we're going to show you some of the shorter term techniques that work very well. Just to let you know too, one of the techniques I have taken and tested extensively in the Australian market, and that's thanks to Dr. David Paul. He's our managing director there in UK, United Kingdom. A few of you might know him. He's a very well-known technical analyst around the world. So prior to joining VectorVest, he was working and training up, I think it was traders and investors, working at some of the world's biggest financial institutions. Right, so he has a wealth of knowledge, and a lot of his swing trading techniques we've used in the VectorVest system. So we've tapped into his wealth of knowledge and picked out some of the best techniques that work very nicely in Australia. So that's in module 4, we'll cover that. So all systems in our system here that we'll teach are rules-based. There's no subjective input required, right? So we look at the price of the overall market. We don't just simply look at, let's say, the ASX 100 or 200, or in the US, look at the S&P 500. We look at all the stocks that we track. We look at the breadth of the VectorVest composites. In other words, again, all the stocks to determine the overall health of the market. And we look at the momentum of the market day over day, week over week, quarter over quarter, year over year. All the key information is displayed in VectorVest, and this is prominent in the VectorVest system each day to ensure that you stay on the right side of the market. Right, so here's a little bit of a sneak peek into the system. Right, so here's our home page, and you can see over here we've got our color guards. So this screenshot was taken just the other day, there on 31 January, end of January. It was telling us the color guard is mildly bullish. VectorVest advocates buying safe, undervalued stocks that are rising in price at this time. So you can start to see what was taking place. Now, here's a screenshot on market timing for Australia. And you can see how accurate it has been. There, if we look prior, there was an entry point there on the 26th of April, and it ran all the way until the 13th of September, to that point. So you got in there, told you to be in the market, if you went from April last year to September, you would have made some pretty explosive returns, right? And I know a lot of our subscribers made some very good returns. Subsequently, we told you not to pick up further shares if you're using our conservative timing signal here. We told you to be careful about acquiring any shares from here to here. So that was the 13th of September right through until the 9th of January. And then guess what? The tide turned again. Here, the 9th of January, we told our subscribers to consider going back into the market. And here we are currently, the market. If you got in on the 9th of January, you bought some very good fundamental and technical stocks, as we'll teach you how to find in VectorVest, you can make some pretty good returns. And I wrote an essay, when was it? I think it was the 11th of January. So once you get access to the VectorVest system, you get the weekly essays. And I wrote an essay there on the 11th of January, so 2 days after we had the confirmed signal. And I noted to our subscribers 4 good quality stocks that had powerful long-term earnings over a 5+ year period. I haven't checked the exact results as of today, but there was a quick 5 or 6% just on those stocks alone. Right, so here's another timing signal in the VectorVest system, the DEW timing system. All right, I won't get into all the nuts and bolts behind it, but it's more aggressive than the confirmed signals I showed. So for example, on the 6th of September, the down signal took place. So it actually came in just a little bit earlier. There it came in as opposed to the 13th on the signal prior. So this one here was a little bit slower. So this is a bit more for slightly more aggressive investors. Subsequently, they're getting into the markets a bit more aggressive. There we noted on the 28th of December, as opposed to the 9th of January there. All right, so we've got all the different timing signals. We've got other timing signals that we can explain in the course as well. Right, so in VectorVest, we provide a color guide which shows you when to buy. I'm going to show you very shortly. Now, the best place to get all your knowledge there is from the homepage. right? So you're going to find all of the key information from the home page as well as the VectorVest views, right? So there's write-ups that take place. So here's a bit of a snapshot that is found within the VectorVest view. So on the views tab, we have all the write-up, but we also put it prominently here on the home page, and you can go ahead and you can read what VectorVest notes each day. So for example here, this was on the 5th of February, so just the other day, and it goes on to note here, prudent investors may buy stocks long the market is rising. Aggressive investors and traders should play the market as it develops with a bias to the upside. And then we get into all of our different portfolios and tell you what's taking place, right? You'll see over here, there's our confirmed up. So that's the signal you just saw here. It's telling us we're still in a confirmed up signal, right? So you get it all here at your fingertips. You can see the trend is noting up. So the market is up week over week as well as fortnight over fortnight currently. So that then brings us to week number 3. This is where we start to develop the worry-free portfolios. This is where countless hours went into perfecting the worry-free system. The parameters for a worry-free system needs to be robust, tested, and realistic. The aim is to have minimal trades per year while maximizing returns. And the portfolios need to be flexible in terms of being able to handle a large portfolio through to a smaller portfolio. We put the odds in our favor. We risk less to make more. So relative safety, RS, it's the key. And we had a bit of a snapshot earlier there where I showed you Goodman Group there. We want that relative safety indicator to be well above 1. The higher above 1, the safer those financials are. So we have it on a scale of 0 to 2 to make it nice and easy to compare different stocks. So the higher above 1, the better. We want to ensure earnings are holding up. We want our earnings growth rate, GRT, it's a 12-month leading forecast on earnings, proprietary to VectorVest. We want our 12-month leading forecast on earnings to be above inflation and interest rates. And we also want to make sure that we are buying stocks where the earnings are consistently going up. So the worry-free portfolio applies the confirmed signals. That's one we looked at earlier, the slower signal for getting in and out of the market. So you'll be able to get into the market later and into the market later and out of the market later, right? So you get in a little bit later, but by getting into the market later, you are less likely to experience false signals into the market. And getting out of the market later is protected through money management and stop losses, right? So although we have an exit signal to say, look, be careful, the market's now gone into confirmed down. You've got that red triangle kicking and telling you to be careful. We use our risk and money management rules to manage us. If we are stopped out, we do not replace until we get the signal to go back into the market. Now, as a result, we'll put emphasis upon safety, that being relative safety, our indicator, which looks at the factors including earnings consistency, company size, longevity, dividend history, and debt to equity ratio. All right, so a lot of that's factored in already into that relative safety indicator. So just quickly how the market works here. We want to buy those safe stocks in a rising market. When we get the confirmed down on a down market, we're not going to replace any stocks, and we certainly won't be buying as a result. We'll wait. If we stopped out, we'll only replace once we get a signal to go back into the market. We're not going to use emotion. We're going to just use scientific, factual mathematics to base our decisions. So worry-free investing is after capital appreciation. So worry-free portfolios pick up plenty of dividends along the way, and plenty of the stocks in the worry-free portfolio allow us to generate further income should we choose through the sale of options, right? So we either buy or sell calls. We either sell calls or puts, right? So from an options perspective, we'd be picking up some options premiums. This is not covered in this course, but it sets you up for those of you that do want to go further and look at courses like the options paycheck course, where it builds upon the worry-free system. So a lot of our subscribers apply the worry-free systems, and then they make further income through the option side of things. But for this course, we're going to be looking at capital appreciation and also covering on dividends as well. Now, I'll showcase a US worry portfolio for you. So I'll give you a snapshot on the US, and then we're going to go have a look at two in Australia. So, for example, here's one that we're going to show you in the course. $100,000 investment back in 1996. That's where the back testing went, all the way back to 1996. And we tested it through on 20 years. I've got the latest results right up until the current date. But for the sneak peek, I'm not going to give away all the trade secrets, but I'll give you 20 years worth. So the portfolio picked up 544 dividends over a 20-year period. And since then, it has powered on even more. Now, 100,000, so that was 100,000 US dollars. It may seem a bit too small for some investors. So using the same portfolio, this time we scaled up to 200,000, then we scaled it up again to 500,000. Guess what? It worked just as well. So it's got to be scalable. So here's the $100,000 one. You can see over here it started at 100,000, 1996, and it's grown all the way here to, what's that, 788. It's gone a little bit higher if I ran it through until the current date. This is about 2 or 3 days behind now. When I took the screenshots, it's powered on even higher since. Not too bad for 23 years, right? Look at that equity curve. So here's the same parameters again, the exact same portfolio. 200,000 this time at the starting point, and has gone rocketed all the way, what's that, just over 1.67 million US dollars currently. So this portfolio has got plenty of scope to move. So if you've got a bigger chunk of money, you may consider this type of approach, right? So that's in US dollars, so it's well over 2.2 million Australian dollars. So for example, here you can have a look at the worry-free portfolio there. This was the one here that did, I think it was 200,000. If we go back here to the 200,000, there it is, yep. So it's just on 1.7 mil. So there it is there. And you can see it's gone on and done 700% return. So effectively, it's grown your money 7-fold since 1996. And you can look at all the different parameters here. Compound rate of return 9.58, the annualized rate of return 30% a year on average. This does not include any dividends, right? So the dividends, when you factor that in, it would be even higher. Here it is again. This time around, it's using $500,000 US dollars. So it started off with $500,000 US dollars back in 1996. And you can see how it's powered on. Look at that. It's just on 3.9 million US dollars currently. If I go back to the slide before as well, I wanted to show you the max drawdown as well, right? So max drawdown, you know, if you consider a portfolio that's gone through the global financial crisis, it's gone through the tech bubble, the housing market crash, all right, it's gone through the recent volatility in the markets. That's really impressive. That means that that's the most it ever lost from a peak to trough cycle, right? So that's what it's all about, minimizing your losses and maximizing your returns. Now, and you'll see here, here's a little bit of a screenshot, for example, on what it's currently holding. But if I go back over here, often I get approached by investors who've built up a large sum of money and want to look at investing plans that can handle plenty of liquidity. One of the requirements was for our worry-free portfolio to be flexible. So on this one here, that's why we started it back in 96 with $500,000 US dollars. You can see it's grown to just on 3.9 million USD. That's about 5.4 million Australian dollars. So the portfolio is holding up very well and able to ensure that the parameters remain conservative. So I'm going to give you a bit of a sneak peek into what this portfolio entails. The portfolio will not allow any stock purchased that accounts for more than 2% of total market volume traded in a given day. So I'll give you a sneak peek into one such holding. There's a ticker code. You might want to go and look it up at the end of the webcast today. DG is ticker code Dollar General, right? So it's an apparel store. It averages around 2.6 million shares traded a day over the last 50 days. You go back 8+ years and go and see that portfolio that average would not have moved much. It's at current price, so it's just over $100 currently. At current price, it's turning over just over 300 million US dollars a day. So that being the share price multiplied by the average volume. So this portfolio currently holds just under 380,000 US dollars in this portfolio at the moment, sitting just on 380,000 holding in Dollar General. All right. So therefore, if you look at it in terms of its total turnover in a day, that being 300 million, in terms of what we hold, for example, in this portfolio, assuming we were here in the cycle, right, we would be holding less than 0.1% of the average daily turnover currently. So as you can see in this course, we don't even get close to 1% for many of the trades, as you've just seen. So no more. Here's another bit of a snippet on it. It will hold no more than 2 stocks in any given industry, with the portfolio holding a maximum of 10 stocks. And here's the thing you can do too with the portfolio. When I show it to you, you can run it using 20 or 30 stocks if you choose. And you're going to get some quite good results there again. So we can stress test this portfolio to hold more stocks if required. But believe you me, with 10 stocks and the parameter sets, you can see over here, this portfolio is comfortably handling just on $4 million US very comfortably. Right, so as I noted before, there's a current snapshot of the diversification. It's quite interesting at the moment. You can see how it's what it's doing, but you can see how software security, it seems to be a big play going on at the moment in the market. It's interesting over here. You can't really see much on anything to do with housing. Right, I'll show you on the Australia portfolio shortly in terms of housing. All right, so here we get now into Australia. So this is the Australia worry-free portfolio for 2019. Right, so we went back, we stress tested. Can we improve things? Every year we're looking to improve things. So we're going to show you how we set this up in VectorVest at the course. So the portfolio withstood the global financial crisis and has powered on since 2013. So it was kind of like in a holding pattern. It wasn't doing badly there, but it wasn't sort of rocketing away. It's kind of in a holding pattern, and then from 2013 off it went. So it's very encouraging to see it stood its ground during the global financial crisis, and a lot of the time it was just sitting in cash. All right, sure, the portfolio might not have been making you a lot of money at that point in time, but consider what would have happened if you'd been in the market during the global financial crisis. All right, so sometimes it's not just about what you make, it's also about what you save. All right, if you've got your capital intact, you've got options, so to speak. You can deploy your money, you can make more money in the right market conditions. If you've lost 70 or 80% of your capital, very difficult to recover from that. Right, so this portfolio has been stress tested over the last 10 years, and the drawdown is, what's that, 11.52. So that's pretty exceptional considering. Now, bearing in mind, this goes back right to 2007. So we haven't gone all the way back to 1996. We've gone back to 2007, but still, that's plenty of data years tested. All right, so plenty of years tested back there. And if you have a look at the returns there, right, it's grown the portfolio 123% since 2007. The annualized average return there, 10.22%, or the compound at 6.89. This does not include franking credits. I shouldn't wear that word out, just depending on the next election, but it does not include franking credits or dividends. All right, so if you were to, let's forget about franking credits, for example, let's just simply concentrate on dividends. That portfolio is annualized over 12% if you take into account the dividends, let alone the franking credits. So this 10 stock portfolio here, you'll be pleased to know it averages less than 9 trades a year on average, less than 9 trades. So no trades have been closed out this year so far, and 2 shares have been purchased this year with an average return of just over 7.5% on average. I'm going to give you a little bit of sneak peek as to 2 of those shares. All right, so here's a recent diversification graph. This is not currently what it holds, okay? This was about June, July last year. I took a screenshot just to show you. It gets up to 10 shares in total, so you can see just how well diversified it is. It's quite interesting at that stage. Infotech software was in there, and then as the technology stocks started to slump quite badly, we whittled out of those positions. And over here, I'm trying to see if I can see. No, there was no housing stocks as such. If I now jump on to what it's currently holding, all right, you can see over at the moment it's got, now I'm not saying all the money is invested across these 3, certainly not. It's only got a fraction of its money invested currently in 3 shares, but those 3 shares account for as follows. So industrials, energy, and transportation. All right. Next one I want to show you here, and that is I want to show you the Australia worry-free top earners portfolio. Right, so this is another one that we're going to be covering in the course. Do you like to look at this profile here? Not bad looking profile, right? And what I like about it is every time it has a bit of a run, then has a bit of a breathe, and up it goes. Has a bit of a breather, up it goes. Bit of a breather, up it goes. There it's had its breather, a bit more of a breather than normal, and I can tell you now, if I update it for the last couple of days, it's around about here at the moment, so it's coming back very strong at the moment. So very nice portfolio. It's concentrating on those top earning stocks year in and year out. So I'm going to show you a little bit of a snapshot here, and you'll see over here, notice what it's annualized, right? So you can see over here, it's annualized 27% annualized, or 12.99% compounded returns. You can see over here in terms of its win ratio, look at that, 44 out of 89. So 44 out of 89. So in terms of a percentage of win rate there, it's about 49%. So how come this portfolio's only got a win rate of 49%, yet it returns about 27% a year? And the secret behind this is it's maximizing its winners and minimizing its losers. So it's, you know, it'll turn over if something's not working, it'll remove it, and it'll get on to the next opportunity and let it run. And if it runs, great, it locks in the profit. If it doesn't, it'll minimize the loss. Right, so you see the compound and annualized returns there, and you can see effectively it's grown threefold since 2007. So the idea being that when you win significantly, and when you place a bad trade, it's covered off very quickly in terms of the loss. Notice how very little is currently being held in real estate. This is the slide I was looking for before. So you can see over here, for example, you know, in terms of where it's invested currently, this used to be a lot larger number. As we see with real estate slowing down in Australia, it started to come in quite a bit. Okay, so it's diversified pretty well at the moment across a few different sectors there. Right, this gets us then to week number 4. Now, week number 4 is a very exciting week because, you know, we've been inspired with the worry-free portfolios, and we're feeling good because we've got some great tools now to test and stress test further, and we can see some very good results in front of us. And then what I do is I then revert on to showing you how to find those best short-term techniques. Now, remember, I noted you're going to probably look at no more than 5 to 10% of your investable capital for these types of techniques. We're going to use very strict risk and money management rules. Now, just to set the scene on this, you know, we're going to look at both technical and fundamentals when doing these techniques. A lot of it's going to go more into the technicals, but we'll certainly overlay the fundamentals as well. So as noted before, it's all about filling up your portfolio with those right stocks. All right. So if I was to show you this one here, right, here's BHP. Right. So if you look at BHP, see the correlation here. So falling earnings, falling share price, earnings turn around, up goes back up the share. So there was the turning point. Where was the price? It was about $20. You start to see a turnaround taking place between $20 and $22, and it's all the way up at 35 plus. Here, the share price was sitting at about 35. The earnings start falling. Share price goes all the way down to where was it, about 14 or 15 odd dollars at its lowest point. Okay, so we're going to find those companies that are growing their earnings, but we're also going to overlay the technicals to pick up the turning points in those stocks. So in this course, we're going to cover 2 swing trading techniques. So I'm going to give you a little bit of a sneak peek into them, all right? And I'm not going to, you know, give away all the trade secrets here. A few of you might recognize 1 or 2 of the lines, but let's not concentrate too much on the lines at this point. I just want to simply show you the technique. So what we're going to do here is we're going to look for a stock that comes in to test the red line here. In a perfect scenario, it just sort of touches the red line, just sort of brushes against the red line here. And we're going to make sure that these 2 lines over here are breaking above the 20 mark. That's all we're doing. And we want to make sure that the red and blue line have got as big a gap between them as possible. It's going to tell us that there's momentum taking place. So, for example, we'll show you how to identify these techniques in the course. There was an entry point for T&E, Technology One. I put a post on this the other day on Facebook about the stock. All right, so 31 December, there it is. There was that entry point there, just sort of touched on there. Then this broke above the 20 mark. Where was the price? You can see the price was just a little bit over $6. Let's call it $6.20. So there it is at $6.20. And there was the entry point picked. Bang, off it went, right? So it went up to over $7. And there is a quick 12% in a couple of days. How many days was that? January through to February, early February, just the other day. So what was that? 1 month, 4 weeks. Imagine going to your bank and saying, hey, here you go. Here's my money. 4-week term deposit, please. I'd like 12%. They're going to laugh at you, right? So, well, if you're prepared to put a two-year term deposit, we might consider 12. In fact, you probably wouldn't even get that on a 2-year deposit. All right, so you'd have to keep your money invested in the bank for about 900 days to make that return. Okay, here's another one. Goodman Group, GMG. Let's look at this one here. So here we can see same technique. This is textbook here. Really just comes in and touches in again. Very nice. Good gap between the two, breaking above that 20 mark there. Right, so there was the entry point, just a little bit below 11. Let's call it 11 for argument's sake. So $11, and you can see over here it rocketed to over 12. Let's say we were still holding this share. I need to double check what the final closing price was on Friday, but let's say it's around about 11.80 currently. You can see over there some quick returns locked in. Right, so just a couple of days there. There's over 7% returns. Here's one in the United States. So same technique. This is what I love about what I teach in this course. If you're not getting the results in Australia with 2,000 plus stocks, then go to the United States. You've got 8,000 shares, 4 times as many to look at. Between the US and Australia, you've got 10,000 shares. Believe you me, you will find these techniques. You will only probably find a handful. And this is the beauty of this course, because we're not just going to pick any old stock. There might only be a handful between the 10,000 shares. You might only identify 2 or 3 on a given day. But look what happens when you get it right, right? So here we are. I looked for this technique in America. There it was, EHTH, eHealth Incorporated. It's an insurance broker. Textbook. Touches the red line, good gap between the two, breaks above the 20. There was the entry point. So what was that? It was about 35, 36. It's between the top end of the 35, 40. So around about the 36 mark there. So there it is. All I've done is I've just put the marker in, right? So I've removed all the noise, just simply concentrate on the share price now. There was that entry point. Look at that, raced away to above 60. So you've effectively just about doubled your money. Not bad, right? Pretty explosive return, that one. All right, so the next technique, a few of our existing subscribers might recognize this technique here, but our second technique here, we're going to teach a little bit more in depth on this technique here, is a very useful technique that has been very prosperous in strong upward trending markets, not just for Australia, but also for the United States. And for those of you that use VectorVest to analyze Europe or Hong Kong or Singapore or Canada, for example, no doubt you've had a lot of success with this technique as well. So we're going to show you just how quick and easy this is to set up each day, where all the stocks are identified for you. So here's the beauty of this technique. All you have to do is just simply go into VectorVest each day, and there's a watch list where it's all sitting there for you. And then all you have to do is just come in and pick the ones that you like best, right? So you don't need to even go ahead and graph them. I would highly recommend you graph them just to look at them, but it's all there on a plate every day in the VectorVest watch list system there for you. So how does this work? What you want is you want all 3 of these lines here hitting a 3-month high. So I haven't got the share price on it at the moment. Don't worry about what all 3 of these lines mean. In the course, we explain all that, but it's just simply identifying, all 3 of these hitting a 3-month high. Now, as it turns out, SAR, all 3 of these lines were hitting a 3-month high long before the 11th of December, right? So they were hitting a 3-month high long before that. But just for an example, which is current, let's just take this one. So it was just the other day, 11th of December. There it's hitting all of them are hitting a 3-month high. If you go look at the share price, right? On the 11th of December, for example, look at that. So $2.80 odd, and it ran to over $3, right? So there is over, what's that, 14% returns in just a couple of days. Same technique again, right? GEM, G8 Education. So 31 December last year, so just a couple of days ago, right? 31 December, all 3 hitting a 3-month high, and there it ran, right? So again, nice little run, over 20% returns that took place. Here's Kirkland Lake, Australia stock here. And on 2 January, this is really ones that I really like, this type of technique here, because notice what I'm starting to do now. I'm starting to overlay some of the other indicators. So this was just purely looking at technical analysis, right? Now I'm also starting to bring in some fundamental analysis. You can see here that the share turned to a buy rating in late December. So by early January, you can see it had been a B rating, a buy rated share for quite some time. And in the course, we'll go into more as to what that all means. But what I like here is when I start to see this, it had been under technical pressure, it had been sell rated, and then all of a sudden things started to turn around. You start to see a huge turnaround taking place here. A great time to jump on for a short-term profit lock-in. Okay, so you see over here, 2 January, turnaround point, and up it goes, right? So you got in, what, about 25, 26, so just over 25, call it 26, and it's raced away to above 30. It's probably getting close now to 35. All right, so that there, you've locked in over 20% returns if you were to sell. Right, and we're going to show you exactly when you need to sell. I'm not going to bring that in now in the sneak peek, but we're going to show you some very powerful techniques as to when to sell. Okay, here's another one, Meridian Energy. Right, so another one here in Australia, Meridian Energy, ticker code's MEZ, MEZ on the ASX. So entry per the 3 lines, hitting a 3-month high. Now look what I've done. I've also put in, see what I'm doing here? So I'm just throwing in a few extras. We've put in the buy, hold, sell rating here. Now I've overlaid the earnings. All right, see the earnings here, EPS, blue line here. So we're seeing the earnings rising. We're seeing the technicals line up. We're seeing a buy rating. All right, so no surprises for guessing how this turns out. So there, just the other day, 20 December. There it is. All right, so it's moved up a few percentage points there as well. So it's just on 9%, it's about 8.5% that it's moved up. That's for 1 month's work. So if you were to allocate a little bit of money, now remember I said no more than 5 to 10%, and I'm not saying you put all 5% of your investable capital into this one stock, you certainly wouldn't. But let's just say you applied the 1% rule, you didn't risk more than 1% of your total investable capital, so about $100,000 to invest, and you invested $10,000, let's say, so 10% into the stock, you're not going to risk it all. You would set a stop loss such that you would not lose more than $1,000, which means that you would not lose more than 1% of your investable capital, that being $100,000. Okay, so we're going to teach you the risk and money management rules, so you're not going to be doing anything reckless. The idea behind this is it's going to help pay the bills, right? So this works in combination with the worry-free investing systems that are giving you the dividends and the capital returns. This is a little bit of extra to help pay the bills on the side or lock in a little bit of extra money. And then we get to week number 5. So this is about putting it all into action. So, you know, leading up to this point, we've shown you some great techniques, and I've only touched on a few techniques. There's a few others, of course, but just time permitting, of course, I couldn't show you them all. But we bring this all then into an action plan where you'll know exactly what to do each and every day. And the way we set it up in VectorVest is we make it so it's quick and easy to do. You should not be spending more than 10 minutes a day max on the VectorVest system once you get it all set up. All right, so we're going to do it in a way that it shouldn't be taking more than 10 minutes a day. All right, so there's the structure again, the 5 modules. So module 1, we get our mindset right. We get into the fundamental and technical analysis on how to look for shares. All right, so that's the module 1. Module 2, it's all about screening techniques, and then getting into the all-important market timing. Then we get into the worry-free investing systems by module 3. So that's where a lot of work has gone into stress testing. We're going to give you 2 in Australia, 1 in the United States, and then we're going to give you an additional bonus one, both in the United States and Australia. All right, so there's an additional one in there as well. I haven't covered those today because I don't want to spoil the surprise in those ones. Okay, the short-term training techniques. So we just had a bit of a sneak peek at those ones there. And then, of course, we're going to show you how to put it all together. All right, so in addition to coming onto the course, and I'll get into the details shortly here, we're going to give you mastery sessions, right? So we're going to release those modules. So you'll see if I go prior, let's just go back here. So each one of these has been pre-recorded, right? So just over an hour each on average. And then what we then do is we release those to you, and then you get the mastery sessions. So mastery sessions, you come along and you ask all the questions that you want in regards to the module. Okay, so we go over the module again, and then we start to apply it. How do we do this technique? How do we do that technique? Can you show that technique again? Can we practice it with another stock or another portfolio? All right, where you get to ask all the questions. So I don't just want you to take theory. I want you to actually apply it. All right. So the next question then comes along to, well, what does this all entail, and what is the all-important cost? All right. So the cost there, $295 USD, and I'll get into the slide shortly. We give a full money-back guarantee. If you're not happy, we're not happy, we will refund your money. All that we do is we ask that you effectively do make the effort to look at the course and do the work behind the course. And if you're still not happy, we'll give you back your money. Now, the last time I ran the Wealth Creator course, not one person asked for a refund. Okay, so the link in terms of taking this out, www.vectorvest.com.au/wealth. Now I'm going to go to that link now for you. So if you put, let me just put it in www.vector. I'll bring it across so you can see. Okay. So if I bring it across here, www.vectorvest.com.au, press enter on my keyboard. All right. That'll then load it up. It's just loading it through. And bear with me. Oh, no, vectorvest.com.au. Oh, help if I put in /wealth. All right, so don't forget the /wealth. So www.vectorvest.com.au /wealth. My webpage is just taking a wee while because, of course, I'm transmitting this webcast, so my internet is a little bit slower than yours. Okay, but this is the page, all right? So you'll see over here, don't get concerned about the date as such. This is not a time when you actually have to attend. This just says officially for our records when the course begins. So I'll run through all the key dates. So we note over here, you've got 2 hours, 2 days and 12 hours to get the early bird price. So I ran this webcast on Wednesday. I'm running it again, of course, as of today. And then the early bird price. The early bird price here, the price I noted to you, $295. That'll close on the 12th of February. All right, so that's Tuesday. It'll close at midnight Sydney time equivalent. All right, so close at midnight. You've got until Tuesday to decide. All right, so and then registration will then stay open until the 18th, and that's the standard price. All right, so for the early bird investors who want to get in early, save yourself $100. And then for those of you that register from 13 to 18, it's $395, and we close the course on the 18th of February. Now, if you're an elite subscriber, so elite subscribers are members who've spent a certain amount of money, be it via courses or subscriptions or add-ons over the years, right? You may qualify for an elite subscription, or it's also for those that have been long-term subscribers, 5+ years. Now, I can't tell each and every one of you whether you're an elite subscriber or not. The quickest way to do it is just to call our toll-free number. So the VectorVest toll-free, that being, of course, remember, 1-800-303-702. I'll bring up that number again at the end of the course, right? So 1-800-303-702. If you're an elite subscriber, then what I'm going to do is, and I'll bring up the slide shortly, I'm going to ask you, please, to email me through, and I will personally ensure that you get the elite pricing, which is even cheaper than the early bird pricing. It's even better, right? But the early bird pricing is very competitive. I think it's a great price considering all the work that's gone into the course. And you then get, so this is what you now get access to. So you'll learn how to build your own SMSF wealth plan, okay, all these key steps, worry-free investing, short-term trading techniques, putting it all together. Right, this is what you should expect, right? Easy to execute methodology. I'm not going to show you crazy trading plans where you're having to do 3 or 4 trades a week. That's not realistic for a lot of people, right? I'm going to show you screen techniques, key to worry-free investing, consistent money-making techniques. The consistent money-making techniques, yes. If you are keen and you want to do it each and every day, yeah, then certainly you could do several trades a day. But remember, this is only going to constitute a small amount of your capital for those of you that wish to do it. All right, we're going to show you that daily plan. All right, so then coming into here, we'll then release those modules. So these are the release dates of the modules. Now, the modules will remain on the system for a year, and we're going to give you access to a special portal to get access to all the modules. So you don't have to watch it by the 18th of February or a week later leading up to the mastery session. You've got a whole year to watch the modules, right? So the idea being that what we want to do is we want to give you a bit of time to watch the module and then come along to the mastery session. And I'll bring up the dates for the mastery session shortly. If you cannot make the mastery session, fear not. You will get the recording and it'll be on the portal or in the one-stop shop place, so to speak. So it's going to be on there permanently for you, okay, for the next year. So if you can't make it, don't worry. You can watch the recording and you can always contact me and ask me the very questions or email me through the very questions that you would have liked to have answered on the day at the live session. Right, so you're not going to be disadvantaged if you can't make the live session. If you can, great. It's quite nice to be part of the live session, but if you can't, it's not a problem, right? So a lot of the courses, for example, that I attend in the United States to brush up my knowledge and skill sets. For example, I'm attending the options paycheck course again in the United States. All right, some of those mastery sessions, I can't get to my computer at the early hours of the morning, but I'm watching the recordings, and you know what? The recordings are brilliant. So chances are the very questions being answered at the mastery sessions were the ones I was going to ask anyway. And if there is a question that hasn't been answered or a technique brought up on the day that I would have liked to have asked, I go, oh, actually, you know, gee, I wish that was covered. No problem. Then just email through and the team get back to you. So I'm going to do that, right? So you can email me as much as you want for anything that is not covered. All right, so they're all the different modules. All right. And then in addition, so as noted there, you'll gain access to all those recordings and the slides and all the key information on there and the spreadsheets and the other bits and pieces we put on there. You'll get access to all that for a year. Okay, so you've got a year, watch it as many times as you want for the year. All right. Then in addition, so, you know, to the modules, as I noted, the mastery sessions, and I'll bring up a slide on the exact dates for those. For those of you that are new to VectorVest, we'll give you access to VectorVest for the duration of the course, 60 days, 2 months access. We'll give you access. All right. Now, for those of you that are existing subscribers that want to come along to the course, for this course, we're going to make use of Pro Trader and Auto Timer or Tester, so Auto Timer. And we effectively will make sure that if you haven't got access to Auto Timer and Pro Trader, we will give you access to those two add-ons for the duration of the course, right? So not only just for the duration of the course, we'll also give you a couple of days afterwards, a couple of weeks afterwards, so you can keep practicing with the tools, all right? So there it is. Now, in order to sign up, so you can click here, register, or you can click down here, register. So you click in here, register, and then it'll load up the screen for you on the registration screen. You then put in all your details, including your credit card. Make sure, of course, you click the early bird rate, and away you go. Okay, so for those of you that are elite subscribers, you know, I'll have a unique way to ensure further discount. Email me through. I'm going to bring up my email address shortly for you. When you're filling in, please make sure that you select this to be Australia. All right, because the team need to be sure as to what course it entails. All right, so there's quite a lot of courses going on. We just want to make sure we tie you back. We would hate to put you into the wrong course. Okay, so please just make sure that's Australia on the drop down when you fill it in. Okay, so I'll minimize out of here. Let's jump to the slide here. Oh yeah, that's important actually to bring this one up. So as I noted before, but again, let's just formally address this here for record, and that is that we're going to provide 100% money back guarantee. So not a 30-day, 100% money back guarantee. You know, by the end of the course, right? By the end of the course, if you're not satisfied, right, we will gladly refund, right, the cost of the course, right? But there is one small thing, or big thing I'm asking you to do, and that is that I'm asking you to take the course seriously. So I'm asking you to do the homework. Don't let the word homework scare you. It's not hours and hours of work, but I want you to practice the techniques we teach. I want you to make sure that you've watched the modules. I want you to make sure that you've watched the mastery sessions. And if by the end of that course you're still not happy, then we will gladly refund your money to you. And as I noted at the last one we ran in September last year, that's why we're bringing it back again early this year due to popular demand. All right. A lot of people asked for the course to come back because they missed it last year and heard good things about it. If not one person at the last course cancelled, all right? So I'd be very surprised. But look, if you happen to be the person that just doesn't get any value out of it, then we will, right? So we're not in the business here to trick or lock anybody into something that they're not happy with. Okay. So, it just comes down to, and this is the last few slides I'm putting in here, how much is this costing you by not knowing what we're going to teach you? All right. And if it's more than the course cost, then sign up and let's get you armed to make the most of the market.
Hi, everybody. Did you like that presentation? Well, right now, we've got other videos for you as well. Click here and click here. Better yet, click them both. Thank you for being as part of these presentations. Take advantage of the information that's there for you. Have a great day.